Hello and welcome to ET Now. You're watching IPO Central, and my company today is EPack Prefab Technologies. It's a company which is into prefabrication structures and manufacture of polystyrene sheets. Its IPO is opening on September 24th, closes on 26th, price between 194 to 204. The total IPO size is 504 crores, which includes a fresh issue of 300 crores. And the company is valued at little over 2,000 crores at the upper end of the price band. And joining me today is Sanjay Singhania, who is the MD and CEO of the company, and Nikhil Botra, who is the ED of the company. Gentlemen, thank you very much for joining us today on ET Now. To begin with, Sanjay, give us a sense of your business model, because you have two business verticals, as I understood from your RHP. Can you just explain the business model to us?
First of all, thank you for getting us on the call today. So our business EPack Prefab Technologies is into prefabricated buildings and pre-engineered buildings. That division comprises of more than 85% of the revenues of the company. And the second business is the packaging business, EPS, expandable polystyrene, which is around 15%. EPack Prefab started as a packaging company, and that is why the name is also EPack, and that 15% is growing steadily. But for us, the major growth driver in this business is the prefab business.
Yeah, it's a diametrically opposite business verticals for you in that sense. What prompted you to move to prefabrication structures?
Yeah. Actually, we started as a packaging company, and the kind of packaging which we do is called EPS, expandable polystyrene. It has basically two applications. One is on the packaging side, and the other is on the insulation. So the insulation products which we made are used for cold chain solutions, in insulating the cold chain solution walls and the floors and the roof. And there was a time in the year 2008 when the market was moving towards the negative temperature cold storages. And that was the time we realized that the product EPS was not suitable to cater to the negative temperature cold storage cold chain requirements. And then we started getting into polyurethane sandwich panels, which are called as puff panels. So we started as a puff panel manufacturing, and then eventually we got into smaller modular housing. We developed certain products for the modular housing, rapid housing, and then eventually we got into the bigger building space in the year 2017 and 18 by setting up our first prefab plant in Greater Noida.
Nikhil, give us a sense of the 300 crores that you are raising from this issue. It's in primary. So what is it going to be used for?
Yeah, so it will be going in three baskets. One is we are doing a capex. We are putting sandwich panel line in the north in Geloth. Around 100 odd crores will go there. Then we are expanding our capacity for pre-engineered building fabrication in the south in Mambatu plant. So part of it, around 60 crores will go there. And then we are also repaying our debt of around 70 crores. So majorly these are the portions. Apart from this, there is GCP, General Purpose Corporate Fund, that is 25% of the balance, that we'll be using for further, requirements of the company.
What is the current leverage on the books, debt on the books as you speak?
The debt right now, or as on 1st of April 25, net debt was around 53 crores. We also, while the total debt was around 210 crores, including the term loan and the working capital limits, but at the same time we had a FD of around 151 crores or 155 crores. So the net debt was around 53 to 55 crores.
Give me a sense also of your order book. You are into prefabrication structures, and it's linked to and it's very closely linked to capex cycles in expansion of manufacturing units and other areas. So what is the kind of order book that you have, and is there a particular sector which you have got more orders from?
That's a great question. In our business, order books give a clear visibility for the next 6 to 8 months. And for us, as we speak, the order book for EPack Prefab right now is around 1140 crores. and most of the like we categorize the order book into three areas. One is on the manufacturing. So when we make new factories, then on the manufacturing side, typically it is around 60 to 65% of the order book for us. Then it is the warehousing, which is around 25 to 30%, and then around 7 to 8% is coming from the high-rise buildings. So as we speak, the factories, we are getting more and more orders for factories these days because of the ongoing capex cycle in the country, and most of the orders, like we are sector agnostic, but still most of the sectors, which are contributing immensely to our order book right now is renewable and FMCG and I would say auto.
Interesting that you mentioned all these sectors, and these sectors are growing in terms of expansion, which is happening to respective industries. Give me also a sense of how your the packaging business is doing. It's 15% of your top line. How is it doing in terms of profitability? And do you plan to continue with that packaging business, given that it's now a small portion of the entire book for you?
See, there's a lot of emotional value to the packaging business because in the year 2000 we started with that. The plant is in Greater Noida. We have only one plant for that, and the plant is in Greater Noida, very next to LG Electronics. And the relationship with LG for this company is more than 25 years. So around 40% of the revenue is coming from one single customer there. And the kind of tailwinds which we see right now in the prefab business, as a management, we have decided to focus on prefab business for now, and the packaging business will continue to grow at a steady pace of 6 to 8%, depending on the growth of its major customer.
Can you also give us a sense of the kind of timeline or turnaround time that you have normally for your order book? What is the normal turnaround time for this order book, which you mentioned that it's over 1,000 odd crores? Nikhil?
Yes, so generally, the project size that we take on an average takes around 5 to 7 months from designing to manufacturing to execution at site. So there are smaller projects which gets done in around 4 months, 4.5 months, 5 months, and there are some bigger projects which are taking around 6 to 7 months. So generally, typically our order book is 7 to 8 months, which we have and we execute in the coming 7 to 8 months.
And what is the kind of margins that are expected in this? Because I'm seeing your EBITDA margin at around 10.4% for FY24 or 25, and that's gradually gone up there. But in because you are into a prefab structures, shouldn't the margin be a little higher there?
Yeah, see, if you see the journey of the last 4 years, our margins have gradually increased year on year, and the increase in the margins is also related to the growth of the company. So as we are increasing the revenue of the company, as economies of scale are getting benefited, and that is the reason for the growth in the margins. Although as a management we feel that the margins would be higher as compared to what we are given in the projections, but still to the guidance to the market from our side is the margin, the EBITDA margin would be close to 11% for us, and in the prefab business it would be range bound between 10.5 to 11, although in the packaging business it's little higher, maybe it's around 11.5 to 12%.
And the packaging business will grow as it is organically, and there will be no investments that you make there.
There will be no major investment in the packaging business as of now. It will keep steadily growing at a pace of 6 to 7%, on the back of the growth of our customers. So that will say, and we have the capacity in-house, to meet the requirements of the next few years.
Also give us a sense of how this business is growing. Over the last couple of years, we have seen a couple of companies in the prefab structures coming into the market. How do you see this business growing, in India for you, and are you also looking at business opportunities outside India as well?
See, for EPack, the last 4 or 5 years has been a kind of a dream run. We have grown 4 to 5 times of the market growth, while the market has grown at around 8 to 10%. EPack Prefab has grown over 40%, and it has been backed by like multiple factors. We have expanded our capacities. We have geographically now present pan India, so we are only the third player in the country to be present pan India. And we have done a lot of work on digitalization of the processes. We have worked on like increasing our team strength, and we have also worked on improving our design capabilities. So backed by all these factors, we already have a proven track record and relationship with a lot of our customers. We are getting repeat orders from them, and this gives us a lot of confidence that while the market is projected to grow at 10 to 12% over the next 3 to 4 years as per CRISIL report, we believe that we will beat the market in terms of growth.
Your CAGR growth is much more than that actually, but when you spoke about your clients and repeat businesses, top 10 customers account for nearly 70% of your revenue. Can you give us an indication of this top 10 customers, and what is the kind of capex plan that they have, and is this a churning list which is there with respect to top 10, or it's a continuous list?
Yeah, see, top 10 customers for us contribute around 35 to 39% of the revenues. So when I say this, the top 10 customers are not the same every year, because this is a project driven business. The good part is we do not have the risk of customer concentration in our company, while customer concentration as well as geographical concentration of the customers. So none of the customers or any single project contribute more than 5 to 7% of our revenues. So that is the way we have structured our company, because we do not want to depend on one single customer or one single geography.
Nikhil, can you also come in here and talk about the working capital cycle that you have, since you have a project cycle of 7 to 8 months and that rotates. What is the kind of working capital cycle and trade receivables that you have in this business?
Yeah, so currently our working capital cycle is around 35 days, and we are trying to maintain that cycle, because that is a very good space that we are in. We are focusing a lot on management of our inventories, of our ARs, so that the working capital requirement stays within the range of 35 to 40 days. So that is the range that we'll be operating in, which we have been operating in the last few years as well. Although it has increased a little on the back of our change in buying. So earlier we were buying steel from a lot of traders, but now we have started buying steel directly from the mills, Tatas and Jindals. So therefore the the payment cycle has increased a little. We have to pay advances to the mills. That is why our AP days has gone down. But overall we'll be maintaining in this range itself.
And the margins which you mentioned that will not be impacted by the kind of the working capital changes that you are seeing.
No, margins will be still operating at the range of 10.5 to 11%. We know we have a penetration strategy where we are growing at a higher CAGR than the industry. Therefore, we want to still maintain this range of our profits and run the systems more efficiently, so that overall our growth is maintained and our working capital cycle is also maintained, with the profits being at the same level.
Yeah, I was just adding to the margin bit. While the account payable days, creditor days have increased for us, but at the same time it has contributed to the gross margin. So like it almost 100 basis point increase, we feel that it has contributed to the gross margin, because like we are able to negotiate better rates from the mills, and our quantities have gone up, so we are getting the benefit of economies of scale there as well.
Mm-hmm. You mentioned that you're going to use a part of the proceed to set up a facility in Rajasthan and expand your existing facility in Andhra Pradesh. Once these facilities come into into play, what could be the total capacity that you will have, and what is the kind of potential revenue that can come from the additional capex that you brought in, and when are these facilities coming on stream?
So as Nikhil said, like we are of the total capex of 160 crores, around 60 crores is going into brownfield expansion of our Mamba 2 plant down south in Andhra Pradesh. So that we believe would be operational by the before the end of fourth quarter of this financial year. And similarly, the greenfield project coming up for setting up or manufacturing of sandwich panels would be getting commercialized by the end of first quarter of next financial year. Revenue projections which we have given to the market for this FY, so the capacities are already in place. It is only for the next year revenue projections, revenue planning that these capacities, especially the one coming up in brownfield expansion in Mamba 2, there the contribution would be around 300 plus crores coming from that facility.
For pre-engineered building structure, currently our capacity is 1,31,000 metric ton, which will go up to around 1,70,000 metric ton after the expansion. And in the sandwich panel product, we have a current capacity of 13,10,000 square meters, which will go up to 22 lakh square meters, 21,10,000 square meters. So to overall, we'll be adding capacities in both pre-engineered building fabrication work as well as in sandwich panel.
Sanjay and Nikhil, it was a pleasure today talking to you on ET Now. Your IPO is opening on 24th, closes on 26th. 194 to 204 is the price band, and you are raising 504 crores through this IPO. Thank you very much for joining us on ET Now today.